Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Welcome to October, the month where you've had the largest one-day percentage gain in the stock market. That was 16% in 1974, and the largest one-day percentage loss. That was 22% in 1987. Markets today, well, they're ripping. Yes, U.S. stocks are at all-time highs, but the UK, Europe, and Japan have all outperformed the U.S. year-to-date. In credit, public IG spreads are at 27-year tights. The 10-year is surprisingly well-behaved. Financial conditions are highly favorable. The IPO and M&A markets have recovered, and energy prices are low and headed lower. What's not to love? This week, our three things are: 1. Credit froth. How real is it? 2. Growth quality. The outlook is brighter, but is it vulnerable? And 3. Q3 earnings. A solid headline growth number is on the way, but weakness lies underneath. All right, let's dig a bit deeper. Credit froth. Well, I hopped on the train this week, opened my Wall Street Journal. Yes, I still get the paper. For those who don't know what a paper is, I can't help you. Opened that paper and was met with this headline: credit markets are hot, but froth is worry. Two sudden bankruptcies in the auto world, the piece went on, call into question a market priced for perfection and ripe for a fall. Ripe for a fall? Well, it's an obvious reaction to the two sudden bankruptcies we got last week and credit spreads that have fallen into or near multi-decade tights. Here are some grounding points that provide much-needed perspective. 1. Credit defaults happen. The question that needs to be asked is whether or not an event reveals that something systemic is lurking out there, that there's been a buildup in outsized, mispriced risk. And that's not the case in our opinion, something the article notes. So far, it says, there is no sign of wider fallout. 2. The piece notes that the larger concern on Wall Street is whether still elevated interest rates, tapering growth, and inflation are making it harder for many borrowers to stay current on their debts. Are rates elevated? Well, the 10-year Treasury at 4.09 is well below its long-term average of 5.83. Is growth tapering? Well, yes, but only from stimulus-fueled levels post-COVID relief. And for what it's worth, the Atlanta Fed GDP Now growth estimate for Q3 is a whopping 3.8%. The Fed is forecasting growth of 1.8% for full year 2026, and that's right on top of its longer-run estimate. And inflation is only modestly above target. We would add that this is a continuation of a macro environment that has been constructive for credit for 16 years and counting. That's the current streak under which the U.S. economy has expanded at an average rate of 2.4% annually, save 2 months at the outset of COVID in 2020. That record speaks, among other things, to the effectiveness of U.S. capital markets. Decentralized and markets-based, markets can be ruthless at bringing about capitalism's essential creative destruction. That force funnels capital to its most productive use while starving deficient businesses. The result is an economy that innovates, demands efficiency, and removes irrational, destructive competition. And that's all good for growth. 3. The piece highlights what the author refers to as paltry credit spreads, failing to realize that investors buy yields, not spreads. So could you argue that credit yields are too skinny for the risk? Well, that's tougher given what still are reasonably solid economic fundamentals and yields that are in the 50th to 70th percentile historically, nowhere near where stocks are in the 95th percentile. All right, on to our second thing, quality growth. So U.S. growth has normalized, at least according to the Fed's latest forecast, with 2026 GDP growth expected to reach the central bank's longer-run estimate, as mentioned, of 1.8%. As a corporates analyst, we're trained not to look simply at earnings. We want to know the quality of those earnings. How durable is that earnings stream? Are there vulnerable concentrations in that stream? Well, we should apply the same thinking to an economy's earnings. What is the quality of U.S. economic growth? Well, we've got some concerns. 1, growth is highly concentrated in technology and AI in particular. Upward of half of first-half GDP growth can be attributable to the build-out of AI. The fact is, you're not going to need to build another whole round of data centers a year from now. Something is going to have to replace that economic earning stream in the future. Two, beyond big tech, growth is concentrated in the largest companies, which in the aggregate make up about half of U.S. economic output. That in and of itself is not all that surprising, but it does imply that the other half, sitting with small to mid-sized businesses, is more vulnerable as those sectors are most impacted by inflation, tighter credit conditions, and rising debt costs. Three, there is a concentration in consumer spending, which is driven disproportionately by the wealthiest households. And we saw how the wealth effect is alive and well by what we witnessed in March and April when spending fell off a cliff. And then there is the jobless growth economy. While the Fed might navel gaze around what Chair Powell calls the curious balance in the labor market, where supply and demand for workers is falling, while that keeps the unemployment rate low, the fact of the matter is we need workers and worker growth to fuel economic growth. Relying on productivity gains has proven to be elusive at times, and deteriorating demographic trends, such as the aging of the population, brings with it a certain sense of urgency. All right, on to our third thing, Q3 earnings. It's that time again, earnings season. Expectations call for earnings growth in Q3 for the S&P 500 to be 7.9% on revenue growth of 6.3%, according to FactSet. If achieved, this would be the 9th consecutive quarter of earnings growth, following the earnings recession coming out of the high inflation period in 2022 and 2023. 8 of the 11 S&P sectors are expected to show year-over-year growth in earnings, led by information technology, up 21%, utilities, up 18%, and materials, up 14%. It's worth noting that the vast majority of earnings growth is expected to come from the Mag 7 and Infotech. And that story only got stronger over the course of the quarter, as among the tech sector's 46 companies, 78%, that's 36 firms, raised guidance over the course of the quarter. Apart from financials, which also figure to report solid double-digit earnings growth, the rest of the universe is expected to show little, if any, growth. 3 sectors are showing earnings contractions, all down 3% or so year on year: consumer staples, consumer discretionary, and energy. Underpinning the earnings outlook are the following themes. 1. Sentiment has improved as uncertainty is lifting and the Fed has signaled that it is cutting rates. The Atlanta Fed GDP Now growth estimate, as we mentioned, for real GDP in Q3 is a whopping 3.8%. 2. Tariff impact has been relatively muted, which speaks to importers stockpiling inventories and adjusting supply chains ahead of tariff implementation, as well as the administration's negotiated outcomes. 3. Falling energy costs have provided a tailwind to the broader market, although a drag to the energy sector. And 4. The now falling dollar has moved to a tailwind for the first time in 7 quarters. And, as previously mentioned, the quality of earnings across the large company universe is not all that impressive, as the headline growth rate and the quarterly winning streak would suggest. So there you have it. 3 things in credit. 1. Credit froth. Don't fall for the headlines. Fundamentals and technicals remain sound. 2. Growth quality. Breadth of this story is not as positive. And 3. Q3 earnings. For growth, look to the Mag 7 and tech. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll be traveling next week, so we'll see you in a couple of weeks.